Hi everyone, it's Kathy Stacey here, and I'm joined by Tim Moffatt from Oakley Financial and Akhil Patel and Phil Anderson. I've got some questions for them in relation to the 18.6-year portfolio that was launched around 6 months ago now. So I thought it would be good to get an update on how the portfolio's been responding to all the investment decisions and where the portfolio is heading. So I'm going to start with you, Tim.
Yeah.
How has it been running, and how has the portfolio been performing?
Yeah, look, it's been going really well. Obviously, markets have been reasonably buoyant since our inception date in March this year, which has been a nice little tailwind. I've got a couple of slides. I'll pull them up and share my screen just to give a bit of context on month in, month out, and how it's been performing against benchmark, the MSCI index. Can you see my screen there now?
Yeah, and while you're, well, not yet, but while you're getting that out, what's the MSCI index?
The MSCI, it's effectively a world index. So it's an aggregate of all the major bourses together and market cap weighted. So it's encompassing everything, but it's very heavily weighted to the US, Europe, Japan, and Australia.
Okay, thanks.
Here's a snapshot, if you can see that in front of you.
No.
You can't?
No, not yet.
How's that?
Yes.
There
Fantastic.
we go.
Got it.
There's a nice little cover sheet for you as well. Just the disclaimer, none of this is personal advice. Right, how's that? So we've got the 18.6 strategic investment portfolio versus the MSCI World Accumulation Benchmark. Technical inception date is early March 2021. So month in, month out, we've been pretty much at or around the index each month. In April, the index had a huge increase, nearly 5%, which we didn't quite match. But all in all, we're roughly 2% trailing in relative returns. Now, what I will say is in around that, we're actually quite happy with that performance because the portfolio itself has been running at over 40% average cash balance. The next chart here is just giving an example. So the yellow line is the 18.6 portfolio, and the blue line is the benchmark since inception. So those two lines you can see roughly are tracking each other in terms of performance, up about 14 to 16% each. But on the other, in behind that in grey is the average cash, the cash level of the portfolio we've been running. So you can sort of see March, April, we're somewhere between 30 and 35%. And then early May, that really kicked up and we positioned the portfolio more defensively, just to protect in case some weakness became apparent in markets. It didn't eventuate, and so we've started to deploy a little bit more capital late July, coming back down. But what you can see is, I'm sure if you can see my mouse, but during these periods where the MSCI had deep retracements, the portfolio itself barely reacted. So on those pullbacks, or these steep pullbacks, the portfolio is actually performing really, really well. That's a factor of the stocks in there, but also the cash weighting protecting on the draw. So despite the fact that we're slightly behind benchmark, we're actually really happy with the performance because the reality is we still have seen us as running, I guess, somewhere through the mid-cycle, and we still see risks of a pullback in markets has been quite present. And primary at the centre of all this is we want to preserve capital in the event that we did get another big drawdown in 2021.
Yes, yeah, I can clearly see the benchmark and those dips, and it's quite comforting to not see those extreme dips in the actual portfolio. So someone that's invested in it wouldn't be having that same roller coaster ride, at least for this period of time.
Yeah, absolutely. Short period of time, but the portfolio itself is doing what it was set out to do. So I don't envisage that it's going to be this defensive through the next 5 years at all. In fact, I suspect if we get a reasonable size retracement from here, that cash level will drop substantially. But the reality is, over the last 6 months, we've actually been very conservative and still, almost toe to toe with the index itself, which is by its nature fully invested.
Yeah, it's good to have that. That's great. I've got a question, Akhil. Have you finished, Tim?
Yeah, I'm just going to stop sharing now. Yep.
All right, thanks. Yeah, Akhil, I've got a question for you. How are you seeing the macroeconomic state of affairs at this point of time? There's quite a bit been going on around the world. Can you summarize it?
Yes, thanks, Kathy. Yeah, thanks, Kathy, and hi, everyone. Yeah, it's been an interesting year. So I suppose we started the year when we launched a portfolio thinking about the progress of the vaccine and the rollout of all that, and whether we would open up. And I think the global economy in general rebounded quite quickly. So either we adjusted, or parts of America and Europe and Australia and so on, at least at the time, opened up, and things were looking like they were returning back to normal. And then the question was, have we overstimulated the economies? Have we done too much? And is that going to lead to a lot of inflation? And so, there's a bit of turbulence in the bond market, which I think is somewhat eased off. And it's eased off because actually, we're not totally out of the woods. I know a lot of listeners will be in Australia, and unfortunately some of you will be in lockdown. There's been this sort of spread of a few different types of variants, which is actually normal for a virus. It's just that this time people are actively commentating on it in real time. Then there's, I think, a bit of question about whether the effect of removing support measures that were instituted last year is going to have an effect. That's kind of why I think there's a bit of uncertainty in the marketplace. But on the other hand, and I think it really is worth emphasizing, most governments around the world have promised or have started putting in place huge infrastructure spending packages. And I think the US is going to pass a second package, or I'm never really sure what the status is of legislation. It's got an infrastructure bill, and then it's got an even bigger spending bill of several $1 trillion. And that is clearly going to be buoyant for markets over the next sort of year and beyond that. So I think overall things are relatively positive, even though some of the short-term news is a bit mixed. And I haven't even mentioned the A word, Afghanistan, as yet. So who knows what the fallout from some of that will be. I mean, I wouldn't sort of overreact to some of that. Such events generate very emotional headlines. Then about 2 or 3 weeks later, people start to focus on other things. But that's kind of the general picture going forward over the next few months.
Yeah, thanks, Akhil. I know in Australia, the RBA was going to taper off its bond buying program, but with the lockdowns in Melbourne and Sydney, they've decided to not taper off and to keep moving ahead with it, at least until 2022. So yeah, thank you for that. I've got a question for you, Phil. If you're Yes, thanks, Phil. Markets globally around May and June were showing signs of topping, but they've actually, most indexes have continued to tick a little bit higher. How are you viewing markets at this time? What are your thoughts on that?
Well, yes, as you know, the roadmap that we use and that we create showed that markets would be pretty energetic into May, and then roughly sideways, with the roadmap suggesting a little bit of downside going into August and September. Events have panned out like I thought they would. If you've been following me for any length of time, you know that I was pretty clear in suggesting that the world events going into 240 months from 9/11, which is July and August, world events would become very emotional. Now you're seeing the effects of that time frame. What was happening the last month or two hasn't been any surprise to me. I don't know why I caught it. If you're watching timeframes, you should have been expecting volatile events. The only difference is this time I believed that all the volatile events would affect markets a little bit more than they have. I thought we'd see a bit more downside, which tells you that the amount of money that the Fed is printing and the stimulus bills has managed to keep markets up higher than they otherwise might have been. There is two things to say about that. There's two rules in markets that you just have to know, and they're pretty basic. Number one is you don't fight the Fed, and when the Fed is in expansion mode, and it's never been as big an expansion as we've got now right around the world, you don't fight the Fed, so you can't go expecting dramatic downsides when the Fed's in expansion mode. So you have to keep that in mind. Number two, markets climb walls of worry. So, the more governments around the world give us things to worry about, the more likely markets are to go up. And, everybody I'm sure knows my view of governments, and I think it's been borne out pretty well. Governments always make situations worse than they should be. It's madness what's going on with government reactions to what the virus is doing. It's just a disgrace, really. It's just yes, minister-like if you followed those old English programs, and certainly the English themselves are carrying out unbelievably complex travel laws. Same in Europe. So what more can you say? So it suits governments around the world. It's just my opinion, but you might have a different one. But it suits governments all around the world to have the population worried about something, because that means then they can't focus on all the real problems going on around the world, of which there are many. And so, just to get back to markets, the more there is to worry about, the higher markets are likely to go, because we need policy responses. So it's all looking very bullish. We don't, in our portfolio, the way we look at things, we don't try to gauge, weekly and small monthly reactions. We are focused on setting up for the longer term picture, and I think that's playing out. We're aware that the portfolio will attempt to take advantage of what we see as the real estate and property areas that historically every second half of the cycle outperform. There's no reason yet to think why that's not going to continue, and that's how we're placed.
Thanks, Phil. I always love how you're able to simplify things, and you've said this time and time again: don't fight the Fed. Yes. And markets climb walls of worry. Yes. I've heard you say that many times. So thanks for reminding us of that. Yeah. I'll go back to Tim. My question for you is in regards to the current portfolio, and what are the key characteristics of it right now?
Yeah, so I guess we're increasingly looking at markets through the lens of the second half. I guess we put ourselves somewhere coming out of the mid half and into the second half. So we've set ourselves some portfolio exposure, like targets for the second half, around risk stocks with certain degrees of risk, and also exposures to certain sectors that we want. So I guess in terms of risk, we're obviously overweight cash. We're probably about a neutral, what we'd like in core stocks, so I'd call core quality. We're also probably underweight in cyclicals and higher risk. So I suspect over time there'll be a movement away from being overweight cash and towards some more of those cyclicals and higher risk stocks, and we're really just doing that selectively as opportunities and or potential market opportunities arise. Mm-hmm. In regards to sector targets, the portfolio is about our target weight for second half in the property sector. We would be still underweight financials and materials, and we're about target on other sectors. So I guess we will be aiming to increase our financials and materials, and in that banks and obviously resources over in due course. We think that's where you're going to get a lot of that outperformance over the next 3 to 5 years.
Okay. Thanks for that. And can you talk through some of the actual changes to the portfolio, some of the recent changes to the portfolio that you've done?
Yeah. Okay. So this quarter, we've had not a huge amount of change. So early in the quarter, we had the bid for Sydney Airports. I mean, that was in reality a real estate stock. It's opportunistic, but also the bid, it was not conditional, so it was unconditional. So there's the potential for it to, I mean, these things can go two ways. You can create a bidding war, and it can also fall in a hole and the stock will end up where it started. So we took it as opportunistic and decided, given the uncertainties around it, take the money and run, and pretty comfortable with that, given the stock's done effectively nothing since we did that.
Yeah, it had that, for those that perhaps aren't aware of what you're talking about, the sudden jump in the, can you just quickly?
Oh, right. Yeah, sorry. So Sydney Airports was trading at around about $5.50 a share. And there was a consortium of super funds and other investors that effectively put an offer on the table to acquire all the shares in the business. And I can't remember the exact price, but I believe we exited at around about $7.70. After a couple of days, we took a bit of time to assess what had happened and what was the likely outcome from here. And it was pretty much, we saw it as a bit of a flip the coin. It keeps going, it may keep going higher if the bidding order escalates, or it falls over and it goes back to 550. And we just thought on, risk-weighted basis, it was time to move on to something else. What else have we done? We also added some Blue Scope. So that's steel manufacturer. It's been performing really well. We started with a moderate position there and we added to it in the low 20s. That's continued to move higher. And at this point in time, probably, should continue to. We bought some Viva Energy, which is a bit of a defensive value play. They're largely a refiner and fuel distribution in Australia. They've done a deal with the Australian government where, from year to year, historically, the refining business can go through very difficult periods and loses a lot of money. They've done a deal with the government because, effectively all the refiners in Australia are closing down, whereby they've put a floor under the refining business. So we think that it'll mean that they can return a lot of capital to shareholders. They don't have to hold a huge amount of capital on the balance sheet to weather those bad years because the government's effectively put a floor in place for them. We think that they've started buying back shares. We think that looks quite attractive and defensive in this market. We bought a couple of resource stocks, some exposure to the EV space in Syrah Resources, which is a graphite miner, has a 100-year or 50 plus to 100-year mine there, and some Aeris Resources, which is a little bit more high risk. It's a high cost copper producer, but it's heavily leveraged to copper and gold prices if they stay firm. So, we're fully aware that that's, I guess, a higher risk stock, but it has the capacity to go materially higher if the copper price holds and continues to climb higher from here, having made, basically jumped up to 2007 highs recently, the copper price. And then the final thing is we pulled out some Deterra Resources. So they're an iron ore royalty. Probably been a little bit of a disappointment over the last few months. Look, we're really just committed to removing stocks that aren't performing, especially for reasons that we can't explain. So I suspect that we'll be replacing that exposure with BHP or Mineral Resources or both in due course. BHP's obviously come off materially in the last couple of weeks. So they are definitely in our line of sight.
Yeah, look, I have to say, hearing you say that you cut the underperformers and you just don't muck around with them is a really nice thing to hear from an investor's perspective. But what are some of the higher performers that you've had in the portfolio?
Yeah, absolutely. Okay, well, the standout has been Unity. Used to be Unity Wireless, Unity Group now. That's been an absolute, I think it's up nearly over 100% from our original entry price. Now it's a great, for us, it's the perfect company. They effectively go into new developments and put in the fiber infrastructure in new housing developments. So from our point of view, we see it as leverage to the housing construction activity that's going on, directly linked to the real estate cycle. And we also see it as a quasi property / infrastructure play where they're in control of the infrastructure they're putting in and they're going to charge a rent on it. So it's also got some great management, very good track record. And so far the stock's, shown very little weakness, which has been fantastic. So it's crept up from, a moderate part of the portfolio. I think it's nearly 5% now. The reality is at this point, we see no reason to sell it. And we'll let it go. BlueScope has been, I think, the next biggest, best performer in the portfolio. We haven't touched or we've added to that position, like I explained earlier. Sydney Airports, look, if it wasn't up on a takeover bid, it was just going from strength to strength, we wouldn't have sold that. But we have now. We had Orocobre, which is a lithium exposure. We actually don't own that anymore. We thought that potentially there was a high when they announced the merger with Galaxy and it started to roll over. But we may be looking at coming back into that in the future. Mm-hmm. And then the fifth best performer has been National Storage, which is a property trust, real estate investment trust. It owns warehousing space. The investment case, I think, is really strong for it. It's had a couple of takeover bids pre-COVID crash on the table. The reality is their asset base, warehousing prices have been going up and have been very strong. So I don't think anything's changed there. I mean, the price is about 230 now, which is still below the lowest takeover bid it had pre-COVID. They did do a capital raising, which probably I think was a bit defensive against a takeover bid personally, but the balance sheet now is under-geared and I think there's tailwinds on that stock from here.
Sounds like you do your research on the individual stocks, so thank you for that. But just for those that aren't yet invested in the 18.6-year portfolio, can an investor go onto their account and see what the portfolio is invested in?
Yeah, absolutely. So the structure that we're running under is under a separately managed account or an SMA. So unlike a managed fund, when an investor invests with us, they actually acquire all the holdings that in the portfolio that we're managing. So when you log on now, you can see that you own X, depending on the total value of the portfolio, but you own X% in Unity shares and X% in Wesfarmers.
Great.
And you can see everything that's going on, including the transactions that we're buying and selling.
Yeah. Oh, that's fantastic. And it looks like we've lost Phil. So I didn't mention earlier, guys, that it's early morning London, and Phil is in Europe at the moment. So I know it's early morning for him too. So we've lost him, and Tim's in Adelaide and I'm in Melbourne. So I've just got a couple more questions for you, Tim. But before I ask you, Akhil, is there anything else that you wanted to offer and that you thought that investors might want to know about?
No, I think sort of Tim talking through the stocks has given listeners pretty good insight into the type of discussion that we have at our regular investment committee meetings. It's about what the company's doing, its strategy, and so on. It's about where it is in terms of price. Phil and I will have some kind of insight on the sort of bigger macro picture, where we see markets in general and how that sort of might affect decisions about a particular stock. And also, of course, I think Phil mentioned this in his remarks, that we have our annual roadmap. And I think, albeit that just to add one final point to what he said, we did feel that markets would be sideways and maybe potentially slightly down into the autumn period. And actually, if you look at certain indices, you think about the Nikkei in Japan, you think about, the FTSE hasn't really gone anywhere since May either. The Dow Jones Transportation Average, which is often quite a good lead index, has been down since May. And in fact, also in the US, the Russell 2000 has had a peak in May. So actually, the roadmap this year has been pretty good. It's just that there have been some very good and strong performance in the US, which have pulled the entire index up. And so I think, we've got all of these different sources of insight and analysis and discussion to inform our investment decision making.
Thanks, Akhil. And just to clarify, when you say the roadmap, for those property share market economic members, it's an annual economic and share market roadmap that you and Phil send out at the beginning of each year.
That's right.
That's what you're talking about. Okay, so thank you for that. So Tim, just a couple more questions for you. Who can invest in the portfolio? Like, is it anybody?
Yeah, look, I mean, everyone. Sorry, Australian, New Zealand citizen, everyone. Whether it's a superannuation fund, a pension fund, an individual investment account, a self-managed super fund, a investment trust, a charity trust. Like there's no limitation. There is a limitation in terms of there needs to be a nexus to Australia. So the entity, whatever that may be, must be Australia, New Zealand at this point in time. So that's how Macquarie is managing their, I guess, international reporting obligations. They've effectively just limited it to Australians. But in terms of entities, anyone can invest.
That's Harry, just wanting to add into that. Thanks, Tim. Can I also clarify, if someone currently has a superannuation funds in a retail super fund?
Yes.
Did they have any ability to have a retail superannuation fund on the Macquarie platform and then invest in the portfolio?
Yeah, absolutely. So Macquarie as part of the platform, I think it's a very, very small additional cost if you're a super fund or a pension fund, like trustee fee, but they effectively provide exactly the same trustee service that your industry or retail super fund provides. The difference is you have much more flexibility via Macquarie and investment choice. And the 18.6 portfolio is just one of those, I guess, additional investment choices that you can use on Macquarie.
Yeah, I think that's really exciting, actually.
Yeah, absolutely.
Because those that you don't have to have your own self-managed super fund, you can invest in the portfolio.
Yeah,
That's
I mean,
fantastic.
the admin costs on platforms everywhere have been coming down across the board. So it's, you're effectively getting a huge amount of the same flexibility, almost the same flexibility in a retail super fund as you got 5 years ago in an SMSF.
Yeah, that's great. I just have one last question, and that's in relation to, is there a particular set time frame that an investor has to be invested in the portfolio?
No. So there's a recommended investment time frame, which is 5 years. So it's a long-term investment strategy, but it's no different effectively to acquiring shares and then selling them again. So you can be in there for a couple of days. I mean, I certainly wouldn't recommend that, but there's no limitation. You're not putting it in and you're not stuck there for any period of time. You can change your mind effectively straight away. You'll take the volatility in the assets if that's what you chose to do, but it's absolutely no time frame restrictions.
Yeah. Okay, great. Thank you. All right. Well, that's all the questions that I have. Was there anything else perhaps I've missed that you can think of?
No, I don't think so. I think that gives a pretty good snapshot of what we've been doing and why. I know Phil was saying that the roadmap's showing a bit of weakness, but the most weakness in that roadmap came in September and October, and we're not quite there yet. So we'll see. It's not over yet.
Well, it isn't, is it? I mean, we've not hit that mark. Plus we've got September 21, which is the equinox and so forth. So we'll just have to wait and see. How often do you talk, like you and Akhil and Phil, and on the investment committee? How often do you get together and talk about?
I might not talk over Akhil, but we're on emails constantly, and we have a formal meeting once a month. But the dialogue, or Akhil can talk to it. The dialogue's basically ongoing with stocks or macro.
Yeah, exactly.
Yeah, that's good to know. Yeah. All right. Well, thank you. I hope this has been a great update for current investors and new investors that are coming in. So if people do want to invest, if they're not yet in it, Tim,
Yep.
who do they contact?
Yeah, absolutely. Well, they can get in contact with us at Oakley. I'll end this presentation with some links that people can go to for either more information or to register an inquiry. Otherwise, you can find our number on the website or invest@oakleyim.com. If you send an email there, that'll find us as well, and we'll either point you in the right direction or help you directly invest in the portfolio.
Great. Thank you, Tim, and thanks, Akhil.
Beautiful. Thank you, Kathy. Appreciate it. Bye.
Okay.